Hey everyone, welcome back to this week's Teaching Thursdays. We're going to cover a topic on bond credit ratings. Now, we've talked about bonds before, so make sure you watch our video on some bond basics just to know what a bond is, who can buy a bond, where to buy bonds at, so on and so forth. But what we haven't touched on is the bond credit ratings. Now, all bonds don't have a credit rating. And when we say a credit rating is simply talking about how well the bond issuer is going to pay you the interest that's owed to you, as well as pay you back the investment amount or principal that you put to get the bond. So when you think about your credit score, you could have a low score, a medium score, high scores, whatever. And so that tells you kind of what your credit history is and how well you've been making payments, if you've been making payments, and if you've been making payments on time. And so a bond credit score is the same thing. It's going to give you, the investor, an idea of how well this particular bond issuer is being in terms of making interest payments on time, as well as paying back the principal money that you invested to get the bond. So when we think of, we mentioned about the bond being having the credit rating. So if you think about it, if you loan somebody some money and they like, okay, if you loan them the money, you say, you know what, I want to get 10% interest on it. And so let's say it's the same situation as a bond. You loan somebody $1,000 and you say, I want 10% interest on it. And the bond or the loan has a maturity date of 1 year. So that means that you're going to get a 10% interest, which is $100, which is 10% of 1,000, and you're going to split that into 6-month intervals. So every 6 months you're going to get paid $50. So you loan out $1,000. In 6 months, someone's going to pay you. That person's going to pay you $50, and then in another 6 months, that person's going to pay you another $50 to cover your interest, and they're going to give you your $1,000 back that you loaned them. That's how a bond works. And so the credit rating is equivalent to how well that person is paying you the interest on time, and if they're paying you the principal back that you initially gave them on time. And so our initial bond credit rating companies are, you're going to have Standard & Poor, you're going to have Moody's, and you're going to have Fitch. These are pretty much the big three that are going to give credit ratings. And so down here we use the Standard & Poor's example. Some of these companies, like I know Moody's uses some lowercase letters. So instead of seeing this AAA, you might see a capital A and then 2 smaller cases A. But the concept is the same. You would just have to kind of look into how each one is structured. But we'll explain how these concepts are. So in essence, when you get a bond rating, you're going to have 2 types of bond ratings in general. You're going to have an investment grade rating, and you're going to have a junk bond rating or a low level rating. And so investment grade is either going to be a high or a mid, and then your junk is going to be low, or of course, worst case scenario is going to be in default. And default just means that they ain't paying your money, So when we talk about investment grade bonds, we're talking about the high and medium. And so that's going to be, here we're using the Standard & Poor's investment grade scale. So here we have AAA and AA. That's going to be your high. Then we have A and BBB. That's going to be your medium investment grade. Now down here you see we have BB, B, and then CCC, CC, and C. That's going to be, now we're talking about these junk bonds. And a lot of times you'll hear on some of these TV shows, they're talking about junk bonds. When they're talking about junk bonds, that just simply means that this bond has an investment grade that is below a medium grade bond. These are considered low grade credit ratings, and so it's just called junk. And the reason it's called junk is because when you think about the credit rating, you don't know if you're going to get your money back or not. Or let me say, you don't know if you're going to get your money back on time, how fast, so on and so forth. So to back up just a little bit, bond credit ratings are going to be attached to corporate bonds and municipal bonds. Now, if you remember, we've mentioned before that bonds can come in corporate bonds, municipal bonds, and treasury or government bonds. Bond ratings don't apply to treasuries. Now, your treasuries, like we said, are the government bonds. It doesn't apply to those. And the reason being is because since these are government bonds, they're considered the highest quality rating that you can get, because it's the government, they're going to pay you your money. And so when you think of treasuries are split into 3 different forms. You're going to have bonds, which have maturity dates that are longer than 10 years. Then you can have notes, which are going to be the bonds that are from like 1 year to 10 years. And then there's you're going to have another form of treasuries that's going to be your lowest amount, and that's going to be basically a maturity date of less than 1 year. But so remember, these scales are applicable to corporate bonds and municipal bonds. And you know, municipal bonds and corporate bonds actually have the higher interest rates or the higher coupons. So you actually make more money from municipal and corporate bonds, but that just means that they're a little bit more riskier in terms of the actual payment. And of course, corporate bonds are riskier than municipal bonds. So now looking at the Standard & Poor's scale here, remember we mentioned this is a high grade, a mid grade, and then we have low grade or junk bonds. And so with the high grade, let's say, you know, Sears decides they're going to issue bonds, or they're going to issue notes. And so it's going to be given a rating. And so that rating is either going to be one of these levels here. So if Sears issues a bond and then S&P, Moody's, or Fitch gives a rating, and since we're using Standard & Poor, let's say Standard & Poor gives that bond rating of an AA, that means it's a high investment grade bond. That tells you two things. That means one, that the interest rate that you're going to receive off of it probably isn't going to be as much as if that rate was either a B or a CCC. However, even though that rate is less, you're more inclined to get your money and get your money on time. So conversely, let's say Sears was issuing bonds or notes and that grade was a CC. Well, now that bond is considered a junk bond because now Sears, they haven't really made their payments on time, or they haven't made payments, to their bond lenders. So that's where this credit rating comes into play. However, because of that risk of not making the payments, or of course this last little here is going to be default. And default, that's just the worst it's going to be. Imagine your stuff went to collections. You know what I'm saying? So basically, let's say that Sears issued a bond and the bond was given a rating of CCC. It's a junk bond now. However, because of that bad reputation Sears have with paying their bond lenders, they're going to give you a higher interest rate to attract you in even more. So let's say if this is a high grade bond, you might get like a 1 to 2% coupon. And then if this is a medium grade bond, you might get like a 3 to 5% coupon here. But now we're getting into junk bonds, you might be looking at 10%, 10% isn't bad, which is what we mentioned earlier. If you have $1,000 bond and you're getting a 10% coupon or interest on it, you're getting $100. That 10% sounds a lot better than 1%, but how much better is it if you're not getting it when you need it? So these are the things to consider whenever you're buying a bond, just looking at these ratings. Once again, this applies to corporate and municipal bonds. If you're getting government or treasury bonds, this is out the window. You're getting your money. It's just you're more so along these lines of that 1 to 3% range when you're dealing with treasury. So you're not getting as much money, but it is safer. So now that goes into diversification. Let's say if you're into bonds, you only invest in bonds. You can diversify by having by having treasuries, and then you can start getting some corporate and municipal bonds and then mixing those up. So now that I have treasury, that's keeping me safe. Maybe I want to get a medium grade bond, get a nice little 3 to 5% interest on it. But you know what? Now that I have this protection from the treasury and these medium grade bonds or medium investment grades, you know what? Maybe let me go ahead and get a junk bond. Let me get something that's more of like a BBB or a C, and I'm going to get a higher interest. That way, if I lose my money, I still can kind of make up for it over here, but I can also maximize the profit from these as well because it's higher. So these are just things that you should look into whenever you're investing in the corporate and in municipal bonds. Now, be aware that a bond's grade can actually change. So if a bond has investment grade of BBB, that investment grade can actually change to a junk bond to a B or a CC. It just depends on how well this corporation or this municipality is actually paying their bond. Now, municipality is just another form of government, really, except it's going to be your more local state governments. So that's why those are a little bit safer than corporate bonds. When you're looking at these credit ratings, the main thing is with these corporate bonds. That's what the ones you want to look out for because they're the ones offering the higher interest rates, but you got to look at what's their bond credit rating. So in essence, that's pretty much how a bond credit rating system is set up. Once again, there's Standard & Poor's, there's Moody's, and there's Fitch's, and these are pretty much the main three go-getters, kind of like the New York Stock Exchange and the NASDAQ are the main two stock exchanges. And then breaking those down, you have investment grade and you have junk bonds. That's the main two things you want to understand. If you hear a bond is an investment grade or if you hear a bond is a junk bond, that automatically tells you about if this bond is probably going to have a high or a low interest rate, as well as if I'm going to get my money on time. And once you figure out if it's an investment or junk bond, then you can really look into see, okay, what's the bond what's the rating. And if you see the rating first, that will automatically tell you, oh, this bond has a rating of a B, it's a junk bond. Oh, this bond has a rating of AA, it's an investment, a high investment grade bond. These are just ways to look at it, and it's just another way to, like I said, diversify your portfolio in terms of your bond assets, because you can actually, if you have a 401k, you can see what bonds you have in there. A lot of those are probably going to be treasuries, but let's say if they're corporate or municipals, at least you can check to see what the bond, what the coupon is, as well as what the credit rating is, to know if your 401k is investing in safe or riskier bonds. That pretty much concludes it for this week's Teaching Thursdays. We hope you get some great information with the bond credit rating. We thank everybody for checking out our last one on REITs, the Real Estate Investment Trust. We've been getting some great feedback on that, and we hope that that this one on bond credit ratings is also going to be helpful as well. Peace.